improvements, primarily focusing on energy efficiency, renewable energy, and climate resilience in low and moderate income households. So thank you so much, Duanne, and we'll toss it over to you.
All right, thank you, everybody. It's so great to be here. I'm super honored for this opportunity and this invitation. And I'm also extremely glad that I am surrounded by women today. This is my first speaking event since I got braces. So I can say that comfortably amongst women. I mean, you can't see them much, but they're on my bottom teeth. So between braces and hot flashes, I feel almost exactly as if I were 16 years old again. So yay to that. I can just imagine my grandmother's face right now looking at me in yoga pants, braces, and at 52 years old and with a big grin on her face, not because of me, but because of the look on my grandfather's face if he saw me today. So anyway, it's just fun to be amongst women talking about what I do and just feeling comfortable, getting through my lisp and my burning cheeks.
Duanne, I was muted and I was laughing my head off. I just wanted to say, if it comes flying out, none of us will judge you. I think I speak for everybody when I say that.
Thank you. Well, I mean, in today's world, I think that, as women, we just got to get past those judgments, right?
Yep.
And that's one of the great things about, I think, not only the job that I do, but being the age I am and being where I am, it's just being comfortable in my own skin. And I hope everybody on, this luncheon feels the same way. We just got to be who we are. We got to do what we got to do. So that being said, just a little bit of background on myself. I'm originally from Bolivia, South America. And I was born there, but I was raised mostly in Asia in 8 different countries, a little bit in Africa. And then I went back to Bolivia when I was a teen. Well, of course, with my family. We went back to Bolivia when I was a teen, and I was very much struck by the poverty. I had lived mostly, like I said, in Asia, in Japan, Taiwan, Korea, and right before Bolivia, the last country was Nigeria. And that really left an impression on me. But I think that where I really became aware of issues of poverty, and I was still at poverty. I wasn't yet at the intersection of poverty and climate and, economic development. Of course, I was 12 years old. But when I went back to Bolivia, as a teen, I really felt compelled to do something about poverty. So I, ran for school president and then, created an orphanage club and kind of that's, how I started to get involved with social causes. And I think that I always felt like I wanted to make a difference. And even though I hadn't grown up in Bolivia, my grandfather, who was a diplomat many years, had instilled in me a great sense of national pride of being Bolivian and taught me the national anthem. So, there was that driving thing inside of me. So I finished high school in Bolivia and then went off to college, back to Japan, and then New York, graduated from NYU, and got offered a job in Wall Street. Not because I was, not because I had any idea about investment banking or banking at all, but because I spoke Japanese. Well, that's my conclusion. I spoke English, Spanish, Japanese, not yet Portuguese, but I would. And at the time, the Japanese banks, Daiichi Kanyo, was the #1 bank in the world. So, people that could speak different languages so they could deploy, bankers across the world. I soon learned, I did not work for the Japanese bank. I chose a smaller firm. And then soon learned I wasn't a Wall Street person, and then kind of bounced back to Bolivia because of love, first love thing, go back to Bolivia. and got recruited by banks again. And unbeknownst to me, at 22, I was working as the head of the credit card department in Santa Cruz, Bolivia, um, after a hyperinflation, and there were 10 credit card holders in the bank. And they kind of said, we're really terrified of this, but you've been using a credit card since you were 17. So if you want to go ahead and run this, I don't want, that's what the regional manager said. I don't want anything to do with it, but we have to make this grow. So here, if you want to take it, take it. And, you know, it was interesting because it was very intuitive how I got into this microfinance and world. And that was the first step. And I found myself working with like transportation groups and like in these solidarity groups to collateralize credit cards, and then doing some student credit cards and all that. But anyway, fast forward. Oh, I just wanted to mention, because this is a women's place. At the bank, I was the only female credit officer in the regional, you know, well, actually in the whole bank, maybe there were two. And we had one secretary that would write up the reports for the credit cards for all the loan officers. And mine would always be late and last, because the secretary would always tell me, yes, but I have to do Oscar's first, and I have to do Mr. This and then Mr. And then I'll get to yours, right? I was also making $600 a month after I had been educated in Japan and New York. And of course, that was half of what my male colleagues were making at the time. And finally, after a really successful year at the bank, making the credit card department grow, my regional manager, who was actually a forward-thinking young guy who had studied in the US, said to me, Duanne, I think, you know, I was like, I'm done with the credit card. It's up and running, recreated the marketing, blah, blah, blah. I'm ready to move on. And he says, yeah, you could do commercial banking. I'm like, that's more interesting, like agricultural loans and things like that. And he said, yeah, okay. And then he comes back to me and it says, sorry, I can't promote you. I can't. I'm like, why? He says, because credit officers that do commercial lending or agricultural loans are on the National Credit Committee, and the owner of the bank doesn't allow women on it. And this was 1993, 4. So I said, okay, well then, thank you very much. Bye-bye. And he said, well, don't leave yet. You know, you're going to get your bonus at the end of the year. And, you know, let's make sure, blah, blah, blah. And he helped me. And then he gave me my first loan for my own business, just with my signature and my father. So here we are, many years later. I moved to Florida. There is nothing for me to do right after the housing crisis. I had been working, by the way, I moved from Bolivia back to Mexico. And in Mexico, I really found my calling, microlending. And I was put in charge of a rural development program in Veracruz that did microlending to thousands of women in rural areas, and also to farmers. And a couple of things started to really become evident. Right? One is, of course, poverty alleviation through financing, right? So I finally was at the intersection of doing good and doing well, and also seeing the economic, social, and environmental development intersect through my work. Also, I finally was able to kind of use the privileged education I had had and exposure to the world, and connect the top of the pyramid to the bottom of the pyramid. So I worked at a foundation owned by an ex-president of Mexico, and they were very influential people. So it was interesting to see the capital flow, although, you know, lots of federal funding and things like that for this nonprofit program. So it was, I had a wonderful mentor who said to me, you know, Juan, the only way we were going to solve poverty is through creating wealth. So that's what we're doing with these microloans. So we were doing $200 loans per woman woman in solidarity groups. So $2,000 for a group of 10 for them to set up their own little bakery or whatever in rural areas. So I literally, I'd go to rural areas, I'd ride a horse, I'd go visit places. I mean, it was the best, funnest job I've ever had until self. And it really kind of, steered me in this path of sustainability. So they invited me to teach at a university, and that's when I started to do my own research as well and understand even more the aspect of, obviously the connection between energy and poverty. Undeniable. Look at Africa. Look at, countries that are underdeveloped. I mean, it's lack of energy. Lack of energy will determine everything: health, wealth, everything. So anyway, so I had moved back to the US in 2009 as a single mother with 2 kids, at 40, needing my mom again and saying, I need my mom's help to raise my children. So I left everything in Mexico. I was doing very well starting up micro lending organizations after I moved from the rural development program to Mexico City. And a successful career, but I had to be a mom, and that was a critical time in my kid's life. So I moved here in 2009. There was nothing for me to do. Back and forth to Mexico, start up a new energy company. Fast forward 2013, there's an opportunity. I meet Doug Coward, who's the founder of the Solar and Energy Loan Fund, and now also my husband, believe it or not. So self brought us together. And after a lot of fighting over budgets, we finally got married. So yeah, that was the best way to solve the budgeting issue. So, here we are. And interesting, because when I moved back to the US, I had this like idealized notion of how things worked. And the first week that I started working at Self, actually as a consultant first, my the person that I was coming to, at the time, I wasn't gonna substitute him. He was gonna work for me. He's this older gentleman working at Self with Doug. I was just getting to know Doug, and he says to me, "Hey, I'm writing up an application for some loan capital from the nuns, and I have to put together some bios." And he yells across the office, 7 people at the time, and he says, what should I write about you other than hot Latina chick from South America? Is this 2013 in the United States of America? I felt like I was back in Bolivia, 21 again. Anyway. So finally to Self. So I start working with Self at the time. Self had been started by Doug, who was a county commissioner for 12 years and a big environmentalist and very well known in the community. And he had thought up this idea of creating a green bank to spur economic development again, create green jobs after, during and really coming out of that horrible housing crisis, and where Florida was especially hit hard. And he thought, well, green jobs. So they got a seed grant from the Department of Energy to kickstart some innovative clean energy financing programs. Because again, to unlock all these opportunities, you need financing. I mean, we can have all the greatest ideas in the world, but if there's no financing, you can't get anywhere. So they got this $3 million grant. About half of it was for operating the first 3 years, and the other half was to create a loan fund. And there were, in 2013, they were mostly through both parts of the grant. They had about 6 months left. And that's when they hire me to kind of expand. And it wasn't clear what they wanted, like what I was going to do. But I knew when I started to see Self model and opportunity that there was a lot we can do, and that contrary to what people were telling me, that the organization had 6 months of life, we could make this a sustainable model. And here we are 8 years later, and SELF is thankfully thriving. So climate loans that transform lives, it's hard to capture everything that we do in terms of whether it's climate, sustainability, but I'll give it a shot here with this presentation. Okay. So SELF was the first and is really the only nonprofit green bank in Florida. Now, a bank is a tricky term that's being used broadly for loan funds and everything. We're not a bank. We are really a loan fund. And we're also a certified community development finance institution, which is a CDFI. And the CDFIs were created to fill the financing gaps in the market. And they basically force banks to channel investments into underserved communities through these financial institutions that are non-regulated by the SEC, that are actually regulated by US Treasury, and that are mission driven. So as a CDFI, SELF has the mandate per US Treasury to do 60% of its lending in low and moderate income census tracts. So, you know, that kind of establishes your target market and your mission and your intent. And we are, you know, we report to US Treasury and all that. And by being a CDFI, we're also able to unlock many capital opportunities, because the CDFI has a fund, a federal fund, and every year it has, you know, a bucket of money that is for us, the CDFI industry, to be able to sustain our operation, cover operating gaps, because typically we're not fully self-sufficient, because we're working in market conditions, but with less than market costs, not cost pricing, but our costs are the same. So we have to have professionals running financial institutions, but we have to deploy capital at below market rates to really meet the mission of serving the low and moderate income populations. And we're in, some CDFIs are for-profit, like credit unions and things like that. But a lot of us are nonprofits because we want to really maintain our mission. So again, we started with this $3 million grant. The innovation that really caught the Department of Energy's attention was that SELF was a CDFI, and the first one proposing to use the model to go into the climate space, or clean energy. First it was clean energy. And you know, I make that distinction because obviously climate is, you know, much broader. And that has now grown from this clean energy focus to really climate resilience and everything, you know. But at the time, this program was started actually as a clean energy program. And using the CDFI structure and tapping into these capital opportunities was really kind of a unique idea. Well, you know, typically CDFIs are going to be doing community development projects like daycare centers and things like that, or they're going to be doing affordable housing, new development, you know, that, and of course the other big buckets, there's three main things that CDFIs do is SBA loans. So SBA loans, affordable housing, and community development. So nobody was really using the CDFI to do like small consumer loans for, you know, energy. So that's what we did. We basically took this model, and I say we because Doug and I joined forces when everybody was telling us there was no way this model would survive. And of course, I was like super excited because here I am. I'm like, we're going to do microfinance in the US like it's supposed to be done, you know. And everybody's like, oh my gosh, what? You guys are doing small loans, unsecured, based on ability to repay. What about credit scores? I'm like, no credit scores. I don't care about credit scores. And they're like, what? What do you mean? But you can't. How can you do lending, you know, to people with less than 680 credit scores? And I'm like, well, that's where I come from. Don't worry. And there was a lot of skepticism, honestly. And I wasn't arrogant about it at all. In fact, I walked into the CFO position telling the board and Doug that I did not want to be a CFO. I had been out of the country for 20 years. I knew nothing about the tax system. But that was like the only position available. So they were like, well, I'm like, okay, fine, I'll take it. I'll figure it out. And you know, it was kind of daunting at first because I had to learn about the CDFI industry and all these acronyms. Oh my God, people, you know, in this world love it. The CDFA, the CDFI, the AARP, the EECBG. I mean, a lot. So, but one thing was clear to me. And it was that throughout my experience in microfinance, addressing productive issues like productivity, you know, lending for productive purposes for small industries, that wasn't enough. We had to, like, one of the things I ran into was that in Mexico, when I started up my own business with 5 business partners to do energy efficiency, is that we ran into the fact that there was no capital for energy issues. And then that kind of, you know, I started to look around, and then when you're giving loans for productive purposes, but there is lack of access to energy, then, you know, it makes no difference. So for me, it was clear that this was a great opportunity here to prove that we could build a financing model to address energy burdens for low and moderate income populations. So the US, of course, very large country, different scenarios, but I'm going to speak really focusing on the Southeast United States. The energy burdens on the working class people, because LMI, low and moderate income, is a very, very wide spectrum. Low income, 30 to 50% average median income to 120% average median income. That's a world of a difference. So if you take the L out, the L is the low income, 30 to 50 average median income. They need assistance. I mean, these are people that have maybe health conditions, disabilities, you know, or have don't really have the ability to produce enough. So, you know, affordable housing, subsidies, etc. Really, though, after that, 50 to 120, you move into moderate income. And what is that? That's the heart of America. It's working class people. Those are the nurses, the teachers, law enforcement people, post office workers. I mean, this is America. And in that moderate income category, most people don't have $400 saved to respond to emergency. In the Southeast, there is about 40% of the population, Florida, some of Georgia, some parts of Alabama, that have 40% of people that are unbanked or underbanked, are not using traditional financing systems. So there is this huge, huge population that needs to be served better. And those populations also happen to obviously be heavily composed of minorities. And those populations, the moderate working class families working 2-3 jobs to pay the bills, are also the ones hardest hit when hurricanes come, when disasters come. They're also the ones paying more of their income, anywhere from 3 to 16 times of their income, towards energy costs in comparison to a wealthy person. So if you have to spend, you know, 30 to 50% of your income just to pay your energy bills, I mean, what's left to eat, to educate yourself, right? So that that moderate income bracket is paying a larger proportion of their income for energy, and that's what we call the energy burden. So they're more heavily burdened by energy costs, and they're also typically paying a lot more for capital. So it's not a double, triple whammy. It's just wham, wham, wham. I mean, people just can't get out from under this whole system built so that, you can't get out of it because you're paying as a moderate income, hardworking, credit-worthy person. You're actually just working away to pay bills and to pay, well, bills is, part of life, but I mean, you're paying so much more, proportionally speaking, and capital is inaccessible or unaffordable. So Self was really built on the premise of serving that market. We want to address that market that needs to reduce energy bills because why? Because they're going to free up about 25% of their they're going to save, about 25% on energy bills to free up cash that can go into something else. Why do we want to do clean energy so much? Because if we're able to do energy efficiency and reduce the demand in the home, then we can put solar and then they can wipe out their energy bill and just have a minimum cost of connection. But wait a second, what did we run into? That we couldn't go from energy efficiency to solar in the LMI, sector, because we ran into the fact that those populations also live in older stock homes and they need new roofs. And when hurricanes hit, their roofs fly off and their insurance costs are extremely high. So then we said, wait a second, we can't just do energy financing. We have to embrace climate resilience. We have to do roofs. We have to do windows, we have to do hurricane shutters. And then over time, eventually, of course, we look at our data, and I'm very much a data-driven person. I love to build my big dashboards and spreadsheets and all that. And I also love technology, so I'm a fintech fan. So we're like looking at all these trends, and we see that, of course, I mean, it doesn't take a rocket scientist to understand that we're in Florida, and most of the people that live here are elderly. So elderly people on fixed incomes, many of them with disabilities. So we then realized that we had to embrace climate resilience, energy, and also home adaptations for aging in place. And all of that is sustainability, right? So that's where we shifted our focus towards. And our loans, are designed to be able to create social impacts, health, quality of life, aging in place, for example, adaptations for people with disabilities, economic benefits, reduction on energy costs, reduction in insurance costs, and importantly, creation of green jobs and retention of green jobs through the contractors. We have over 500 contractors affiliated to our network. And then, of course, we have the environmental aspect, which is every time we do energy efficiency or we do a solar project or we are doing a water quality loan, then we are advancing our climate goals and we're reducing our carbon footprint and preserving our communities. So back in 2013, we had a loan portfolio of about $1.5 million, and I think it was $1.4 million. And to date, we have raised $24 million, leveraging about $90 million in projects. And what I mean by that is that, we use our capital to then bring in more capital. And now we're getting into the stacking of capital to create bigger projects. And that's something that's really fun and powerful about being a CDFI is we can leverage grants. We get a grant of $200,000 and then I go out and raise 2 million against those 200,000, And so anyway, that's one of the fun parts of my job. And I get to do that by raising capital through the nuns, through impact investors, and through Kiva. We've raised almost $1 million. Anyway, I'll get to that later. But basically, to date, we've done $17 million of unsecured loans and about 2,000 loans. Now, we were a staff of 7 at the time. Now we're 15, but we actually hired last year during the COVID 1 year. We hired 2 staff people because demand went through the roof. And you can imagine, people staying at home, people needing high efficiency air conditioners, people needing to fix their roofs. So it was incredible, but we're fortunate enough to be able to increase our staff. So we service over 1,200 loans per month in our little offices in Fort Pierce, Florida. 74% of our clients are low to moderate income per HUD. And all of these loans are unsecured. They're not mortgage loans. They have no liens on the homes, none of that. And we have less than a 2% default rate throughout. We have over 500 contractors in our network. And what I mean by that is that we basically affiliate, we pre-vet and ensure that all contractors that work on the projects that we finance are legitimate, are licensed, are insured, and are going to do their job. So when we give a loan, we don't give the money to the person. We approve the person for the loan. Then we actually issue the notice to proceed to the contractor that they select, they choose from our contractor network. We verify the pricing to make sure there's no price gouging. So we're protecting the customer, which is really important, especially with the elderly people. The things we see here in Florida are horrific. So we make sure pricing is right. We issue the notice to proceed to the contractor. The contractor does the work. When the work is done, we verify that it's done. They have to submit inspections and compliance and all that. And then we pay the contractor. So actually it works really well for both parties, right? The homeowner is protected because we're not going to pay the contractor until the job is done right. And then the contractor is protected because they don't have 30% of their project. And then the homeowner may say, oh, I ran into something and I can't pay you the rest, and the roof's already installed, So it really helps both sides, and we don't charge anything to the contractor. We don't have any financing fees. So that's a good thing. So anyway, in 2019, we were fortunate to have been awarded $5 million by the JP Morgan Chase Pro Neighborhood Grant program. And that is kind of is a new thing for us in terms of what we're going to do with it. So we are going to use the $5 million to make an equity investment into affordable housing developments or rehabs in a land trust. And actually the land trusts are developers, and this is going to be for 300 affordable housing units that are green, that have the maximum energy efficiency technologies. So again, we are pushing the envelope on making affordable housing green. We're trying to push for public housing to become green, because I mean, there's nowhere else that it makes more sense to do energy efficiency or to get rid of energy bills than in affordable housing. So anyway, we're going to use that grant to push that envelope a little bit. So let me just move on quickly. I'm going to see how much time, how are we doing with time? I have like a couple of minutes, or am I done?
No, you're doing great.
Okay. Does anybody, I'm sorry, I'm rambling on here. Does anybody want to ask a question or? No?
Yeah, don't have any questions in the chat box at this point. But you guys are welcome to ask.
Hey, Duanne,
Oh, Laura's got a question. Yeah, go ahead, Laura.
Hey, so Duanne, this is Laura, and I went to Florida State with Doug, and I'm so excited to hear about how you guys met, because we haven't yet covered that topic. But when we're done, because I've been talking to Doug about partnering with Self, can I grab a few minutes of your time after the fact? Because I have questions related to what you're talking about, but I don't know if anybody else really cares at this point.
Absolutely.
Okay,
more than happy to. Yes. Thank you. So, I'm just, yes.
Oh, sorry, I didn't want to interrupt. Hi, I'm Liz, and I'm a lawyer in Los Angeles. I work with companies, lenders that finance all sorts of affordable housing and green projects, but they're traditional lenders, that have large branches that might have a commitment to urban development, that type of work, but they're traditional for-profit lenders.
Right.
And I'm wondering, I mean, it sounds like you have a very different approach being a nonprofit about your underwriting. Clearly you're not looking at credit scores. You're lending to individuals, not to organizations. Can you talk, maybe this is part of your presentation, but what does your underwriting look like? How do you underwrite these individuals?
Yes, no, it's a great question, and I do cover it, but I'm going to go ahead and talk about it. Let me clarify. We don't determine a loan based on credit scores, but we do look at credit scores. So one of the components, and let me go here. Hold on. I don't know if I can go back. Yeah, one of the important components about our loans is financial inclusion, and the reason one of the reasons why we pull credit and report to credit bureau is because of what I stated early on, which is a lot of people need to grow their credit scores to become included in the financial system. So by reporting our loans back, then we're advancing this financial inclusion portion. So credit score is one of several things that we look at. So we do a very traditional, old school type lending method that is now on steroids through Salesforce and systems that we've developed and created. And, but basically we do a P&L for every person, which is, a budget. We have them fill out an application with a very detailed budget, their income, and we do an income expense. And then we take a very small percentage of their disposable income that we see. So our underwriting really is based on a couple of indicators that, again, they come a lot from this microfinance methodology, tropicalized here, but we look at disposable income, we look at the traditional DTIs like banks do as well. So it's a combination, and I created this little scorecard from the combination and input of all of these. And then with that scorecard, we can see a certain red flags, right? And we have thresholds. Like our DTI, banks typically are at 40%. We are at 45, that's kind of traditional. But if we have somebody with a borderline DTI, but it turns out they have disposable income and they have a credit history, not score, history of payment that is good, then we can approve a loan. The reason is that when you look at credit scores, unfortunately, again, in the system, a lot of people are punished by medical bills or by, life events like divorces or by things like student loans. And we just don't think that that is okay. So we basically do a very in-depth underwriting. And what that means is that you don't go online. I mean, you go online and apply for our loan, but you don't get an instant approval. You get a pre-qualification. We have a really cool app that we developed, so you can get pre-qualified, and say, yes, it looks like you qualify. But really to qualify, you have to wait 24 hours, 48 hours sometimes. And we have a lot of questions. Our underwriters will reach out and what's going on and this and that. And in the end, we will approve people with 0 credit scores, 500 credit scores, because we found, I'll tell you a story, one of my favorite stories. Ruth, elderly widow with 0 credit because her husband had all the credit. She never had credit in her name. So now she's alone. She's on fixed income. She owns her house outright. Her roof is damaged from Hurricane Irma. She can't fix it. No, it wasn't Irma. It was a previous hurricane. Hurricane Irma is on the way. And her daughter reaches out to us, desperate. This was in the northern part of Florida. And she says, okay, I heard about you guys, and I don't know if you can help us because nobody wants to give my mom a loan. And I am willing to co-sign, but she has 0 credit score. And, we don't know what to do. And we're like, of course, this is a person that's credit worthy. She has income, she has disposable income, she can afford to pay the loan. She just doesn't have a credit score. She has 0 credit score. So sure enough, we got her a contractor and she put a new roof on, and a couple of weeks later, Irma went ripping through her neighborhood. She would have lost her home. She pays on time, you know, I mean, and what we do is, so the way to look at this, and you know, it is from a human perspective. You know, people aren't numbers, aren't scores, and you got to get to know people. So for example, a case like that, we will ask a family member like her daughter to co-sign, because of course we're a lending institution. You saw we have less than 2% default rates, but that's because we do prudent lending. We also don't approve everybody. Sometimes we tell them, you need to go back and do this and that, you know, take a credit rebuilding seminar. And then you need to come back to us. Or you need to put down a cash collateral. What does that mean? It's a cash guarantee where you put up, you know, 3, 5, or 10% of the loan amount. So if you need a $10,000 loan, you put up $1,000. Well, but I don't have $1,000, because people don't have $1,000. And we tell them, well, if you have the ability to repay the loan like you say you do, despite, you know, what we're seeing, then you should be able to save that same amount for the next 2 to 3 months. And that will be your cash collateral. And then we will use that as a guarantee, give you the loan, and we're going to apply that payment towards the end of the life cycle, the loan cycle, to reduce your interest and the term of the loan. So again, Liz, sorry, Liz, can I call you Liz? I think you said Liz, it was Elizabeth. When we do our underwriting, we are looking at a couple of indicators that, again, now thankfully are all, you know, in our system. And there's an ICC. Every single loan gets looked at by internal credit committee, and our underwriting is really based on those combinations. Does that make sense to you? I mean,
Yes,
most people don't want to do what we're doing. It's a lot of work.
well, yeah, I mean, it sounds like you guys just have a much more extensive underwriting process, which I'm sure adds to your operating costs.
Yes.
Which I imagine tightens the belt a little bit.
Yes. And again, you know, it was very, very tedious. And, you know, one of my goals is to always be increasing efficiency. So we're able to invest over $100,000 2 years ago, thankfully, in developing systems. Like, I think that really the way to serve the underserved market is with more efficiency and more technology. So we got to ride the fintech wave, but we got to ride it in a way that serves our mission. So I always was kind of into building these systems when I started up organizations in Mexico. So one of our goals is to be able to capture what we do manually right now more and more through systems. So we get to that point where there's always going to be a personal touch, but at least we have now more data that we can, you know, kind of process that. And I'm dying to meet somebody that wants to, you know, fund us to take this to the next level in terms of our underwriting methodology, you know, so that's next on my wish list. So anyway, these are a couple of our programs. We design different loan types and partner with different organizations to be able to meet all of the market demands. So our CDFI's flagship program, basically all types of loans for everything that you saw in that little house before, you know, energy efficiency, climate resilience, water conservation, of course, clean energy, solar, it can be geothermal. That's not usually the case in the Southeast. But anyway, and then we have Kiva. I don't know how many of you are familiar with Kiva, but we're one of 10 field partners in the US. Kiva is the juggernaut in crowded peer-to-peer lending, crowd-funded, sorry. I don't know if it's my braces or just me, but it's a platform. Think of it as a GoFundMe if you're not familiar with me, but instead of you donating money, you're going to be lending in $25 increments to somebody around the world. There is, I think it's like about 2 billion micro investors across the globe right now that use Kiva. So what we're able to do, it's really cool. We're able to post one of our clients. Typically, we're focused on veterans and women, single women heads of household, but now it's open to everybody that is low to moderate income with low credit scores. So for example, our 500 credit score people or 0 credit score people that, you know, are kind of, we're on the fence with, will say, well, why don't we post you on Kiva? And then we have 30 days to raise the amount of the funding for the loan. So if it's a $10,000 loan, we have 30 days to raise that amount, and people from all over the world get to see. So this is another great, great story, because we have clients who have posted on, you know, Friday night, and then by Monday, $10,000 have been raised from 5 different continents, literally. 300 people from across the world. And one of my favorite things is when you go on Kiva and one of our loans is funding, you have teams. So like you can set up a women's and climate tech team, and you can then use that team to get notifications when somebody is posted on Kiva and needs an investment. You create your little portfolio. Now, what do you get? You're going to get your principal back because our loans repay. We're doing the underwriting, but you won't get an interest. We as Self get a 5% interest. And, but then when you get repaid, you get to reinvest, you know, so your money just helps and gives and gives and gives if you continue to reinvest. And, you know, it's really fun to see with teams. Like we have a Self Mighty Green team, and then there's, you know, the NYU team and this and that. But my favorite is when you see the Christian team next to the agnostic team, next to the atheist team, next to the Muslim team, next to, and, you know, it's just like, you know, the world has a common cause. None of those differences matter, you know, and Kiva is a place where you get to see that. It's really kind of neat. The other thing that I love about Kiva and about, you know, some of our other programs is that really what we're doing is kind of shifting this paradigm where, you know, the wealthier get all the benefits. I have nothing against wealth. I mean, I have had a privileged life, and I'm very comfortable with it. So I'm not this kind of person that is like, you know, oh, I don't think that people should get, you know, overly wealthy. No, there are no limits. The point though is that there should be more equitable financing and capital available. There should be more equitable energy. I mean, equitable, not equal. And what I mean by that is that the poor shouldn't be paying more just because they're poor, right? So the challenge for us is to shift that paradigm and say, if you have the lower credit score, the lower income, or the 0 credit score, you're going to pay the least in interest. So you are going to access our lowest cost loan with that profile. And Kiva is our 5% 5-year term loan. And that's our lowest interest loan. Then we have our Safe Home, which is resilience loans. This covers roofs, impact windows, et cetera. Typically, those are around 8.5%. So again, when people say, well, that's not a low interest. Well, if you're comparing it to a mortgage loan or to a home equity loan, no. But these are unsecured loans. I went through the trouble the other day of photocopying about 16 credit card offers and other loan offers, personal loan offers that I've been getting. I guess my credit score is getting good because everybody wants to throw money at me. And I'm like, okay, well, now I have, you know, like, I don't know, it's not great, but maybe I'm around 750, 760 credit score. And I opened them up because I'm curious. And the lowest offer was 13% for me with that credit score. So, you know, when we're talking about an 8% unsecured loan for people with less than 680 and 640 credit scores, it's a third, a fourth of what they may be paying in the marketplace. So just keep that in mind. Sometimes people try to compare, you know, to these other secured loans. It's not the same. And then we have water quality loans. So I already talked about how our loans work, so I'm not going to go over there, but I do want to share with you this last part, which is our our new projects, expanding from that single family, owner occupied or not, but I mean homeowner, to a broader, bigger scope of lending. And this is our multifamily, nonprofit, and community energy development improvement loans. And we're doing this with the JP Morgan Chase funds. We've created the Housing and Community Impact Fund within SELF. And we are currently, in fact, raising some capital for that. So I'm hoping to see a couple $1 million drop in the next couple of weeks for that purpose. And our goal is to actually provide these mezzanine funds to be able to stack capital and do larger scale projects, but again, with the same focus on energy resilience and aging in place. And we want to really push for everything that we're going to be investing in to be maximum energy efficiency and clean energy and resilient. So that's something we're excited with. We also partner with other green banks that we are in the same network, the American Green Bank a coalition. And then we do some neat, innovative things. Like we just created this septic to sewer loan. So septic tanks are a big threat to our environment as well. And Martin County had $200,000 and they were going to do 20 projects at $10,000 a pop. And they said, we're not financing people. This is the utility. So would you guys deploy those funds? And we said, well, why are you only going to do 20 projects? How many houses do you have to connect? And they said, we have 400. And we said, well, don't do 20 projects. Let's do 200. They said, how? And I said, give us the 200,000 as, not give it to us, use it to pay down $1,000 per project. And we'll bring you $2 million and we'll deploy the loans for you at the same cost you were going to do with $85 fixed payments per month for your clients, but you collect on bill for us. So it took us 1.5 years to figure it out, but we got it done. And now we've launched this program, which is one of a kind in Florida and hopefully will be replicated. But again, just creative solutions to problems and leveraging. They had $200,000, now they have $2 million. So that's moving along. And then the other thing that I'm really excited about is that we also got a grant a couple of months ago from the Lowenstein Foundation to do the first rooftop solar project on a public housing building in Miami-Dade. So again, this is, public-private partnerships, there was this opportunity, and through our networks, I reach out to somebody at the Office of Resilience. I'm like, do you guys have a building that you want to do, a solar pilot on with us? And it's all about people. It's amazing 2 women. It's mostly women go, absolutely, let's do this. And they come on board, and thanks to them, they bring a building that had the possibility, and they said, we're going to change the roof. Let's do a solar ready roof, blah, blah, blah. So now we're going to do a solar system with a battery storage for emergency response to climate impacts. And it's going to be a pilot, first of a kind, only one, which is like, we're in 2021. It's crazy, but we hope that it will be replicated. And that's another thing. So again, we are a triple bottom line impact model. And I just want you to take 1 second to take a look at this picture. Can you see that picture up there with the 2 ladies? That's Roy. He's been with us. Most of us have been with SELF for now 5 to 8 years. Roy is our loan officer for the Treasure Coast region. And the lady with a white t-shirt going like this is Caroline. And she came into the office with her friend after back surgery, had no air conditioner. It was summer, almost 2 years ago now. And her house was 102 degrees indoors and nobody would give her a loan. She had a 520 credit score. And she was teary-eyed with her friend, and her friend was saying, I will co-sign for her. She is an excellent person. She will repay every cent, on and on. So Roy, who's a great guy, he's like, let me walk you through, blah, 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 worked with her. Next thing you know is we hear cheering and crying. So we all run out, what's going on? And it's her right there, just in tears, thanking Roy and saying, yes, she had just gotten approved. and we were able to help her. So that's one of my favorite people. And she came in and then she fell in love with Doug and she kept on coming up to me. Oh, he's so handsome. Anyway, that's just a fun story. And I'm going to wrap up very quickly here. This picture, that's Doug on the right, now my husband, and me on the left, and that is Sister Corinne. And Sister Corinne is an amazing leader in the socially responsible investment world. She was the first one to give us our first investment after the grant way back in 2013. I interacted with her. She said to me, let's go over the financials, Duanne, because I don't understand what's going on. And I had just started a couple of weeks ago, and she says, let's have a Skype call. Skype, remember Skype? And I said, sure. And I could feel that ruler coming out of that screen, just like hitting my hands, like she was not happy with what my predecessor had sent, honestly. And she says to me, I don't like to get into details, but can you open up your projection sheet? I said, sure. She says, okay, I don't like to get in the weeds, but on column F, line 16, do you see the same number I see? I'm like, oh gosh, okay. So after a 3-hour Skype conversation, she said, well, I wish I could invest more. And she gave us our first $100,000 investment. After that, she moved and created another fund. She was with with Adrian Dominican Sisters, created another fund, RCIF, invested another $200,000. Adrian Dominican increased to $250,000. She introduced us to Mercy Partnership, $600,000. Then we became known in the faith-based organization world, and 13 faith-based organizations invested in us, about $3 million. So she is an amazing, incredible, one of the most incredible women I have ever met. So this is our loan capital composition. Right now, we just closed a $5 million line of credit with Bank United. So you see that bank loan capital pretty heavy there. It's a CRA investment. So as CDFIs, we're also good candidates for CRA investments. And then we have impact investors. Faith-based organizations is now smaller because the pie has grown. We have grant loan capital, which is basically the CDFI fund, has a yearly round, and we apply for funding and we get loan capital that we don't have to repay, but we have to deploy first in loans, and then it becomes our equity. And we have health systems, basically, again, the connection between health and energy and resilience. These are large health systems like St. Joseph, Bon Secours, Dignity Health, who are now doing impact investing in organizations such as CDFIs. Then there's other types of local government grants. Are more like service contracts, and other grant capital like Lowenstein Foundations or JP Morgan Chase. And then we have Kiva. And this week, I think we hit $1 million raised through Kiva. So anyway, if you want to look more at this, the distribution of our clients, types of loans, you can see energy efficiency and wind hazard. That's a cumulative. This past year, roofs were number 1 and AC is number 2, which just again shows what, So these are just some of the faces. And with this, I want to wrap up. I know that it's it's an hour, but I don't know if we have time. This is Sylvia Thompson. Her child has cerebral palsy. We were able to help her with an AC. I'm sorry, let me go back for a second. This family on the left, 16 adopted children. They needed 2 ACs in their home. Pamela Turner, veteran, medical bills. Her credit score was shot, so we were able to help her. And I wanted to share this video. What do you think, Kat? Yeah?
Yeah, absolutely. And then I do have just a handful of questions for you, and then I think we can wrap up. But yeah, definitely.
So this is a post office worker. Can you tell me if you still see this screen?
Yes,
Okay.
We'll just need you to unmute it. There you go.
ABC
Make it a
Action
little
News,
bigger.
the only local TV station offering a flash briefing on Alexa.
Sorry, we gotta go through
To add the
this.
skill, go to abcactionnews.com/Alexa. Then ask Alexa, what's the news? Here's your flash briefing from ABC Action News in Tampa Bay.
As the temperature continues to climb, so do those utility bills. ABC Action News reporter Robert Boyd tells us about an organization that's helping frontline heroes of this pandemic get a cheaper option.
Well, I'm on top of the roof of Mark Stanhope. He's an Army veteran and a current postal worker, and he just had some solar panels installed 2 weeks ago.
At the post office, I'm a mail handler, which means I run a forklift, actually move carts of mail on and off trucks that bring mail to and from our processing plant in Tampa.
On any given day, Mark Stanhope could handle at least 500,000 pieces of mail. During the pandemic, he's seen that number dramatically increase.
And it almost feels like Christmas time because we've been very busy.
Outside the post office, there is even a banner to show appreciation.
If you're going to be called a hero, you better be a hero.
But despite the accolades at work, at home in St. Pete, Mark is just trying to pay the bills. So he looked into solar panels.
It was something I really wanted. I went through like 8 or 9 different companies, and I just couldn't get the financing that would work.
That's when he heard about the Solar Energy Loan Fund, or SELF. And before he knew it, solar panels were lining his roof.
Our customers are generally low to moderate income families who do not have a lot of financing options available to them.
The nonprofit community lender helps with a variety of energy efficient upgrades, including air conditioners, insulation, and wind mitigation.
People are home more than they have been before, using way more energy than they have been before. And now they are really affected by the cost of electricity.
Mark said it's nice to know blue-collar essential workers like himself can save money and energy too.
It's like you have to be rich to be solar, but SELF makes it so where everybody can have solar.
In St. Pete, Robert Boyd, ABC Action News.
All right.
The ABC Action News
So,
team
wait, I
committed to
gotta
tackle
stop
the
this
big
now. I
issues.
don't know how to do that. Okay. I think it's stopped. So that's about it. These are the faces of our clients, a hospice nurse that couldn't afford a new AC, and more stories, so I'll be glad to share with anybody who's interested the presentation later. Thank you.
This is great, Duanne. Thank you so much for sharing. We did have a couple questions pop up. So one of them is from Nika, I hope I'm not butchering your name. And she asked, can you fund shared solar?
Great question. So we're in Florida and right now expanding into Alabama, Georgia, South Carolina, but I'm going to start with Florida. Florida, you cannot do like that type of community solar, or you can't do power purchase agreements. We cannot, it's illegal for us to produce energy to either sell or share. So unfortunately, we can't finance it. If we were legally allowed to do that, then we would be financing something like that.
Okay, great. And within that answer, you answered the next question, which was from Natasha, asking if you were just in Florida. So well handled. And we've gotten just a ton of just comments in general about how much they loved the individual stories. So thank you for sharing those. And then the final one was from Megan asking, well, first she says amazing work, but then she says, for Safe Home, do you provide feedback on the types of projects that homeowners should pursue? And do you layer climate change on top of that for long-term resiliency? She says she's thinking more along like helping people adapt to rising heat and seas, and saying it'd be a shame if they added flood protections that were inadequate in 20 years, for example.
Yeah, it's a great point and question. Thank you for bringing it up. Hi, we actually do energy audits, for example, and we encourage people to get them. So initially, we actually required people to do energy audits, but we also had a large grant to pay for them because a clipboard audit is not enough. We do kind of a blower test in this. A little more than just a clipboard. We actually hired a green vets program to do our auditing, and I think it's very advisable, and we still encourage people to do it. But $270 for an audit is not something everybody can afford. So if we don't have the grant funds, honestly, we don't require it. But whoever wants it, we do recommend they get one. And then whoever wants it, we can definitely supply it. I think you make a great point. What we do internally is we always try to advise the clients to go in a step-by-step approach. So you're absolutely right. You don't want somebody putting solar before doing energy efficiency, weatherization, insulation to reduce the demand in the home, to seal the envelope. You don't want somebody doing a roof that is not a fortified roof that has hurricane straps nowadays. You just, why? You know, it's just another $500. So we do provide that energy expertise with the loans. But we need to do more of that integration that you're talking about, you know, and that's where we partner with a lot of other organizations right now and trying to expand that work to really embrace all the climate, you know, flooding and all these. That's a little bit outside of our realm, but that is ultimately the goal. And I think that more organizations are going to be involved in this type of work. We're seeing a huge surge of interest, you know, to replicate our work in others. And right now, as you all, well, I don't know if you all know, but there's an infrastructure bill that we're hoping is going to pass. It includes a national climate bank, or what's called a sustainability and sustainability accelerator fund for green banks to provide capital for what you're talking about, everything from sea level rise, you know, flooding protection and all that. And we're working very hard with the Green Bank American Green Bank Consortium and Coalition for Green Bank, and you know, all these other groups trying to advocate for better practices in general. Great question. Thank you.
Thank you.
All right, and I think Lisa's going to wrap us up here with a good one. So she says, if you were to start Sell from scratch again in a different state or region, what would you do differently, and what would you do the same? I love it. It's like an interview question.
Wow. Well, so are we going to do this somewhere? Because I'm ready. Let's see. I think that I would do a couple of things differently. One is I would use some of that. If I had the grant funds, the same grant funds, I would definitely invest more in technology up front, because that prevented us from scaling faster, you know. And when I, you know, finally was able to get the board to approve that large investment, it was already like 2015, 16, 17. Anyway, so the first thing I would do is really, really try to integrate these different underwriting methods into systems that could produce the same results. Number two, so technology is one of the big things. Number two, I would possibly create a B Corp and then create an arm for a CDFI nonprofit. And the reason I do that, I don't know if a B Corp, but maybe even just a for-profit. And the reason is because, you know, there is a mission-driven component that is wonderful, but also sometimes limiting. So I would try to have a broader perspective from the beginning, not start with just clean energy. I would start with a sustainability climate vision, and I would create an arm to address larger type projects. Now, my passion is people, so therefore the residential sector really appeals to me more than infrastructure, highways, I don't know, you know, things like that. So I would still do it focused on residential people, people and the residential sector. But I think I would want to push the envelope more than just the it's such a heavy focus on just the LMI, so that we're pushing all housing into the green sector more actively, you know. So that's another thing I would do. Not sure exactly what that looks like, but I think I would definitely revisit that. And what was the second part of the question? What would I do different, and what would I do the same? Yeah, what I would do the same is I would re-meet Doug and get married to him again. And sorry, but no, seriously, I think that what I would do the same is tap into the faith-based organizations, the socially responsible investing, really integrate these capital sources that are not traditional into our mix, because that not only keeps us true to our mission, but it really, I think, it sends out a very important message and allows us to do this flexible type lending. So I would definitely keep that nonprofit side. Again, maybe I wouldn't make it all nonprofit, but I would definitely keep that and work with the faith-based organizations and do these kind of creative experiments that we've done all over again.
Awesome. Awesome. Duanne, thank you so much for your time. Helen, Julianne, Lisa, is there anything from just in closing or any questions you guys have to wrap up? But Duanne, on behalf of everyone, thank you so much for your time and just sharing this really, really great stories. And I loved your the personal stories. That part gets me every time. I'm like,
yeah, I love that too. I love that too. Thank you so much.
Thank you so much, Duanne. It's so incredible to hear your story. Really phenomenal. I'm glad we have it recorded.
Yes.
Thank you, everybody. Did you take a screenshot of that you can share with me so I can brag about you guys and what you guys are doing?
I don't think the recording has all of our screens, but if you want to, I can take a screenshot right now.
That would be great.
Everybody do your hair.
You guys get on your cameras. Thank you. Thanks for having me.
Oh, this is so great.
Yeah, if you can do it, because.
All right, smile. All right, let me just get
the sound effect and everything. That was just like,
yeah, thank you. It's great to see everybody.
Sorry, Duanne, I'm just going to ask for one more.
Yes.
Okay. Awesome.
Oh, I love it.
As women, we need more than one picture option, you know?
Always.
Of course. Well, we will send out the recording of this shortly and provide it to those that couldn't make it today. But I think this was fantastic. So thank you all for your time and joining us. And Duanne, again, thank you for being here today. And hope you all have a great rest of your week. And we'll see you for next month's call.
Sounds good.
Awesome.
If anybody wants to follow up, you have my email.
Yeah, we'll put that out as well. Duanne, we'll send that to everybody. So I imagine your LinkedIn will start blowing up here momentarily if it hasn't already. And
well, I hope you all connect with me. Yeah, definitely.
Absolutely. Absolutely.
Thank you.
All.
I feel really warm. Thank you for your, yeah, thank you. Have a great.
You crushed it with, again, I still don't see any braces. So I just remove that from your worry list.
No, I'm not worried. Just getting used to it. I feel 16.
Well,
thank you so much.
All right, bye guys.
All right.
Bye.
Bye all.
Bye. Oh, I was going to stay on with Laura.
She had to drop. So she sent me her cell phone number. I'm going to send it to you in an email here real quick, and you can just give her a text.
Okay, excellent. Thank you.
Wonderful. Thanks so much.
We'll talk. We'll be in touch.
Okay, great. Thanks, Duanne.
Bye-bye.